So as we enter into 2019 on the Independent Investor channel, I know there's a ton of people who have made their way to the channel. For that, I want to congratulate you and welcome you. I thought I would come out with this video and talk about my 10 most important tips really for a new investor. Anybody looking to take on this challenge of becoming a self-directed investor, I'm here to offer you a testimonial to let you know how empowering of a message it is. And for you guys that are just kind of making your way into the channel, we're going to continue to invest into 2019 strong. We really are. These are fundamental principles that I've deployed for most of my life, and they've really paid off well. And I just want to share these principles with you guys. These are going to be contrary to what you may hear across the YouTube landscape, but we're going to continue to deliver a unique message that is aimed at individuals taking simple steps in becoming successful in the stock market, and anybody can do it. Typically, when you end up faltering in the stock market, it typically is because you've not abided by a rule, or you haven't set up a game plan for yourself to follow, and volatility starts to strike up and you start to second guess your plan. So I'm going to offer these 10 tips as really a game plan for you guys. If you had some questions about how to define the landscape of investing, which is, it's confusing to a lot of people. I get that. I really do. But I think there's a lot of misconceptions out there that turn people off of investing, as opposed to tuning into somebody like myself who can really simplify. I've got 10 words. That's it. I've got 10 words up here on the board. We're going to go through each one, and hopefully maybe you pick out a few of these that you can really put to good use in your own investing career, because I just want the best for each and every one of you guys that come and prescribe to the channel and kind of listen as to how I deploy, put up with the volatility, block out the noise, stick to my plan, things like that. And I just want nothing but the best for you guys. So let's jump right into it. Number one, I talk about this all the time. You need to approach the stock market from a builder's mentality, all right? And I can't stress this enough. You don't start building a house only to put a few bricks in place and then get irritated 4 hours down the line as they're starting to dry and start ripping everything out, okay? You have to approach the stock market from a builder's mentality, all right? You're not going to be able to have a perfect portfolio overnight. It's going to take years to build up, and if you're approaching it that way, you should really understand that by pragmatically building the portfolio in pieces, you're really going to allow yourself to put a nice piece of the portfolio to work immediately. And then you're going to allow yourself the decision later on down the line, when you fall back on those decisions, as you add to the portfolio over time, the opportunity to build upon your strong base in your portfolio and not have to go back and correct problems that maybe you rushed into stock, overexposed, things like that, to where you're having to go back and fix mistakes that you've made in the past. You always want to err on the side of safety when you're putting your base in place and taking that builder's mentality. That's why I offer the idea for a lot of you guys to enter into a passive base, a passive index fund, or a passive ETF that's going to provide you that manufactured diversification right away. It's going to pay you that dividend right away, and it's going to give you that exposure that's going to kind of help you fine-tune some of the other attributes of being a successful investor that we're going to talk about here in these other points here. Now, number two is going to be your tolerance to the market. And a lot of people have heard this term, but it's so important to sit back. And I always address this with new investors. And typically, a new investor on a scale of 1 to 10 is going to come to me and say, Ryan, I'm a 7. I'm a 7. I don't have one day of experience in the stock market, but I can handle anything. I'm a 7. I'm here to tell you guys, I'm a 7. I'm an aggressive investor, all right? I'm not a 10. I do not like to see my money fluctuate violently, okay? I do not try to overexpose to the stock market. That's why a lot of you guys know that I keep a pretty good hoard of cash on the side, and I do have a small pillar of fixed equities in the portfolio. But this is going to be something that you're going to want to just award yourself a risk tolerance, whether or not you're a conservative, a moderate, or an aggressive investor. And I've broken it down for you guys on a scale of 1 to 10, 1 being somebody who has a savings account, and that's about all they want. And as you kind of step it up, you enter into a basic investor category, a moderate investor category, and finally an aggressive investor category. And the important thing to understand with risk tolerance is just this. It's not a hard and fast rule when you assign yourself an initial risk tolerance level. It's not. Start as a basic investor, one with a conservative risk tolerance with the expectation that it may change over time as you end up having more net worth in your life, or you end up incurring some financial wins in your life that you're able to take a few of those dollars and put them away. It's going to strengthen your risk tolerance to say, look, when I first started investing, I didn't really have any idea what I was doing, but I came to this independent investor channel guy, and he seemed really excited about investing, and I sure as hell am. I'm very excited about investing. I'm more excited for the prospects of investing for you. But give yourself a chance, a fighter's chance, to succeed in the stock market by not over-assessing your ability in the stock market. And you guys might hit this on the head. That's fine. If you say, Ryan, I'm a risk tolerance 10, then you better be able to invest like a risk tolerance 10, all right? If you're going to invest in all growth stocks and you're going to put a higher than average amount of exposure in all growth and maybe some cryptocurrency, you better be able to handle the swings of those particular investment products. That's all I ask. That's all I ask. And I ask that you're honest with your assignment of your initial risk tolerance and maybe aim a little bit low with the idea that you can evolve that risk tolerance over time, all right? Because these are all intertwined. All of these investment principles, they're all intertwined with each other. If you do these top tips for 2019, they're also going to help you avoid a lot of and block out a lot of the mistakes that are made in the stock market as well. Number 3 is your exposure limit to the stock market. This is something that nobody talks about. I'm really the only one that kind of offers this idea of investing a certain percentage of your investment capital. For those of you that didn't hear what I just said, I'll break it down this way. Just because you have $1,000 to put in the stock market doesn't mean that you have to throw it all at the stock market all at one time, right? Pick an exposure limit that you're satisfied with, especially if you're sitting out there and you're a spouse and you're looking to deploy different levels of capital and different risk tolerances within 2 different portfolios that are supposed to kind of harmonize with each other, right? You'll always want to pick the level of exposure. And again, like risk tolerance, start on the defensive side of the house, right? You're all winners as self-directed investors, so why overexpose yourself and get overzealous on the stock market? Just pick an exposure limit that you're comfortable with. Guys, if you're sitting on $100,000 out there and you've never invested in the stock market, take 20 grand, take 10 grand, take 10% of your total overall capital that you have eligible for investment or earmarked for investment and scale it into the stock market. Give yourself a fighting try to succeed in the stock market instead of cutting your legs off right away and taking the entire wad and throwing it on this, which is a volatile stock market, right? Define your level of exposure. Define the percentage of exposure to the stock market that you are comfortable with taking a starting position. And for you guys that are going from 0 to whatever X amount in the stock market, that's going to define your level of initial exposure to the stock market. Very, very important. So many people miss this. So many people will save up to that first amount only to dump it on the stock market in a taxable account. The account will adjust back 20%. They'll pull all their money out, incur a taxable event, and they will be done with the stock market. If you hear me out on this point, this is really one of the most important points that I stress on the channel, and there's so many other videos on YouTube being pumped out through the through the conduit and putting a lot of content in front of subscribers, and none of them are talking about this, guys, and it is critical to success in the stock market. Getting your exposure limit right, it will absolutely be your ticket to a lot of sleepful nights, okay, and avoid a lot of restless nights, all right? Number 4, as we all know, the importance of the account, but more importantly, the designation of the account, all right? The self-directed Roth IRA account. For you guys that are new to the channel, we know how much we advocate for that. I know I've had some folks hit me up and say, what's the benefit of waiting till I'm 59 and a half? Well, listen, I anticipate being 59 and a half and reflecting back on my life and the investment decisions that I've made. And there's no way in hell that I'm going to put myself in a position where I look back and I regret not tax protecting money and not wealth preserving money. We do both with this type of account. All you really need to do is choose what aesthetics within the platform are going to be conducive to your needs. And I would stress this, don't overthink this part of the process, okay? So many people want to pick the perfect account. The account, no matter with Vanguard or Merrill Edge or TD Ameritrade or Charles Schwab, they're all going to provide you the conduit or the connection to the stock market. And in the end, that's what we're looking to gain, all right? So don't overthink this process thinking that you can royally screw up. All right. Now, when I compare the difference in aesthetics between an M1 Finance and a First Trade is aesthetically a lot different in that it's more of a traditional layout, whereas M1 is more of the pie layout, okay? Now, there's no one more right than the other. It's just that some clients or people are going to gravitate more to certain aesthetics, either with, for example, an M1 or with a First Trade. And the trick is to kind of pick that one that's going to be the best for you guys, because it's just going to be kind of a logistics headache to have to switch brokerage houses over time. And I'm here to tell you, I've done it many, many times. I've been with Merrill Edge for a long, long time, and I'll continue to remain with them. You guys know I've started up my additional First Trade account, so I'm going to start to build up another pillar of the portfolio with First Trade. But find that broker that really, really makes you happy and stick with them. If you can do it with your primary bank, whether it be Ally Finance or JP Morgan Chase or Bank of America, look at the prospects of doing just that. But making sure that the critical piece to this entire equation is in place with regard to the designation of that account. I've got some brokerages that are trained to tell would-be clients when they ask about a self-directed program to question whether or not that even exists. I'm here to tell you that it absolutely exists, and in 2019 you will continue to not have any advertisement for this empowering message. That's why you got me. All right? Number 5, to diversify is so important, and it's one of those things that gets overlooked all the time. I understand that there's a lot of instant gratification that needs to be had in the stock market, so you want to go out there and buy the Amazons and the Googles of the world, the Facebook, right? Some of the high growth, high beta names, but diversification will get it done for you. It is the #1 defensive technique to allow you to put your portfolio to the test when volatility kicks up, all right? You guys have to understand that if you do put that $1,000 to work and you've tuned into my message and I've given you enough motivation to say, you know what, Ryan's right, man, I do need to seek out some participation level in the stock market, it's gonna be by the very nature of your diversification that you seek out that's gonna allow you to build upon your existing base and not go through violent swings in the stock market. That is your very defensive mechanism in the stock market that is going to allow you to look at your program and say, you know what? I hear all these people that are talking about timing the market. I hear all these people talking about the stock market being some sort of scam, which I'm here to tell you the truth. the stock market's not a scam. And if you've lost money in the stock market, you should probably look in the mirror and look no further than blaming yourself for those missteps, all right? The stock market is not a scam, all right? But you need to approach it seriously, and you need to deploy fundamental strategies like these, the top tactics, really, that are tried and true over time, instead of trying to default to the temptation of timing the market. Diversification will help you do just that. Number 6 is the product that we're going to choose. So many people want to focus on this exclusively, all right, with the top 3 stock picks of the month, blah, blah, blah. You need to buy these stock picks, and here's 3 more, and here's 3 more, and here's 3 more. And you don't have any type of plan. You just throwing these stock picks randomly into something. It's sure as heck not a plan, right? But the product itself should relate with your level of tolerance and your exposure limit. Remember how I said these all tie in together? That's why I make it so simple for you guys. And you guys know how often I reflect upon the Vanguard products, all right? There's so many other products out there, but this is just your introduction to the stock market to say, you know what, if I was going to buy the total stock market index, I can go with a VTI. That's why we provide these solutions for you guys, so you don't have to do any legwork, all right? I would insist that you do get into the research on your own, but I've made it so easy. And with a product like VTI, it is one of those products that doesn't require any analysis. It doesn't require any experience. It doesn't require anything other than for you to get this fundamental stuff right, so you can enter into a product like VTI to know that you're going to be paid the dividends, to know that you're going to be diversified across the entire stock market index, right? To know that you can dollar cost average that fund up if it does end up adjusting down. Understand that if it does adjust down, to know that you're buying more shares of the stock when it does go down. When it does go down, instead of saying it's a scam, identify it as an opportunity. That's the beauty of the product piece. Now, we do offer, of course, the idea of expanding the portfolio over time, and we'll kind of get to that. But don't think with regard to the product that there's a perfect product out there. I would insist that there's never ever been a better time than today to buy some of the fine companies that we offer, some better than others. Now is a great entry in Apple. Now is a great entry into Costco, Home Depot, McDonald's, the financials, the energy sector, right? There's never been better entries into those particular times, right? But to buy a company like Amazon really at any time during its history would have been a good time. So my question back to the group is fundamental analysis or technical analysis really necessary in hitting a home run every time with the product that you put in the portfolio? I think not. We're looking to buy the best companies out there in each of the sectors, and there are 11 of them. And out of those 11 sectors have the best of the breed that this country and abroad have to offer with the products. And I don't want you to overemphasize the importance of just picking the perfect stock, all right? The perfect stock doesn't exist. There's no stock that exists within the stock market that is somehow exempt from or immune to going down, all right? And most of them at some point will take a trip up and will end up going into a downturn, all right? So that is the importance of picking your product in context with your risk tolerance and your exposure. Place the right product in the right account in a diversified manner. Check your exposure, your tolerance, and take a builder's mentality. Guys, I can't simplify it any more than this. And if you guys are joining the channel for the first time, you're getting a real treat with this video. 7 is the expectation. You must have realistic expectations of the stock market. And when I say realistic, expect the stock market to go down, all right? Expect it, all right? If you've listened to me and put all these things in place over time in building your portfolio, you'll be able to have fair expectations. And a fair expectation of the stock market is not, hey, I'm going to invest in this stock and it's going to make me a millionaire, or it's going to go up every single day, all right? Or investing in 2010 and then just get used to every single year being an up year in the stock market and then expecting that to somehow continue forever. All right? Those are not realistic expectations of the stock market, all right? And I want each and every person who tunes into my channel, all right, not to be entertained, but to hear me out on this point. Why? Because I'm right. I'm right. You have to have realistic expectations of the stock market. And I don't want you to have realistic expectations because I tell you to do so. I want you to have realistic expectations because you understand how important it is to understand that money is going to fluctuate over time, right? An expectation to enter into the stock market and not understand that that capital that you're putting into the stock market at the proper exposure rate is not going to act like invested capital is no expectation at all. It's really kind of amazing to me how when we get involved in the stock market, and I see it all the time on YouTube, it bothers the heck out of me, but this is why I came out with this channel, to provide a voice of reason for all conditions of the stock market. Why? Because we've all lived through these different conditions. Anybody less than 10 years of experience in the stock market needs to hear it from somebody like me who's been investing for most of my life, that understands that stock can get volatile. And it helps you understand these expectations to say, you know what, when you're speaking with your spouse and you say, you know what, I've got this $10,000 that I want to invest, but Ryan's talking about having realistic expectations. And he's talking about the prospect of the stock market at certain times going down. Maybe we don't want to take that whole $10,000. This right here helps define this exposure limit to the stock market. Very, very critical in understanding that your expectations need to be more long-term over time, but to understand that your expectations will go hand in hand with determining your exposure and your level of risk tolerance over time, guys. You have to trust your process. You must be able to trust the program that you've put in place for yourself. I give you all the tools. I give them all to you, all right? You have to be able to trust the power of compounding interest. Trust the power of dividend reinvestment. Trust picking those products that are diversified in nature. You may not have the validation as to why you're doing it when you first step into it, but trust that this is the way to go. You must trust that this is the right decision here. Trust that your instinct may be telling you to just put that $10,000 all into Facebook right now, all right? But your tried and true fundamentals, that of which you've learned on the Independent Investor channel, will tell you to take a pause. Take a pause and sit back for a second and say, if I deploy this decision, how am I going to feel about it tomorrow after it's deployed, all right? Always think like that. Think with a defensive mindset. Think, what is it that's going to be to make this decision a good one in an up market or a down market as well? If I put a diversified product in my portfolio and I trust that process, I'm trusting the fact that if that product goes down, I'll be in a situation to buy more. If it appreciates and goes up, great. That's what we all want in all of our products in the stock market. But to trust your system is imperative. And I find that a lot of people's trust is really, really easy to have when everything is rosy in the stock market. The trust is a false sense of security when everything is rosy in the stock market. But when we start to get a little bit of volatility, whoa, 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 that's when people start coming around the channel and they're like, huh, whoa, 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 you need to somehow drop all the trust you've had for the last 25 years in the stock market and just flush your entire program down the toilet. That's what you're supposed to do, Ryan, right? And that's never, ever, ever been a way to approach the stock market, ever. Are they thinking that one of these times they're actually going to be right and then they can say, I told you so? There's been 45 downturns, recessions in the history of the stock market. There has been not one of them where selling short was the way to somehow circumvent those recessions. That's not what you do when you trust your program, right? Not what you do, all right? Number 9, you have to be able to evolve with your program. This is not one of those things that you're going to deploy, and I don't want to scare some of you guys that are sitting across from me saying, okay, hold on, what do you mean, Ryan? What do you mean evolve? You mean I've got to actually manage this account? No, I don't even like that word. That's why I did away with it. For you guys that have paid attention to the channel, I did away with managed, and I adopted the word directed, because that's really what you're doing. Directed, managed, they're synonymous in my mind, all right? But I look at self-directed investing as being fun. It's fun. You have to be able to evolve with your program, man. If you wanted to put that diversified asset in there up to your first 10 grand, which is what I recommend, go about doing it. But you're going to reach that 10 grand threshold. And I don't speak about money in a way that if you have $1,000, that I don't think for a second that you're going to take that $1,000 and turn it into 10,000, and then 25, and then 50, then 100, then $250,000. Then you're on your way, baby. You're on your way. I don't speak to people like that. I speak to the $1,000 investor the exact same way that I speak with the $500,000 investor. In my mind, it's all relative. All right? It's all about perspective in how you take the very best principles and deploy them for your own benefit in the stock market. Must be able to put yourself in a position to evolve with the times, add to your program, earmark your gaps and overlaps, right? That's why I came out with that video. It wasn't very popular on YouTube. That's fine. Did it need to be said? Yes, it did. Why did it need to be said? Because nobody else is saying it. That's why. All right? And that helps you understand the evolve portion. Instead of looking at your portfolio and the fact that it's down 20%, why don't you look to the right and the left and try to identify what it is you can do to continue to take the builder's mentality, right? Think outside the box, guys. Don't think tunnel vision all the time. Look to the right, the left, the up, the down. Don't always look right down the center of the lane. Because if we've done everything that we've possibly done here, that center lane is working for you guys, whether or not it seems like it is or not. It's a beautiful thing, but you always got to look to see what gaps are available or identifiable in the portfolio to make sure that you can always look to strengthen and stoke that fire in that portfolio. Very, very important over the long term. Make sure that you reflect back over your life and you're able to reflect back on the fact that you did everything in your power correctly to stoke that fire and build up this financial wealth that we're looking to achieve. Number 10 is one of the most important things, and that is monitor. You have to be aware, all right? And I'm not talking about daily interaction with your portfolio. Quite frankly, guys, I actually want the opposite for you. I want you to tune into a channel like the Independent Investor channel, maybe pop into a few live streams every Friday. I'm there every Friday. Pop into a few of them every now. Take a little bit more of a concerted effort on your financial health and savvy, right? Take a little bit more of a concerted effort on your financial stewardship in your own personal lives, whether it be you as a single person or you and a spouse, and maybe even you and a spouse together. How about that, right? Let's monitor these and let's be some self-directed entities, that of which do not need the interruption or the interference from the large financial institution, guys. With every new subscriber, we are churning this discussion. With every new referral that you guys provide for me, we are churning this discussion. With every new person we bring to the message, we are empowering people. And all they've got to do is walk a 10-step process, man, directly into the stock market. And by monitoring your portfolio, you're going to be paying attention to the very thing that is important in investing and avoiding all the other crap that seemingly is so distractive to a new investor. Guys, thank you so much for tuning into the message, man. You always want to subscribe to the channel, hit the thumbs up button, and hit the notification bell to give yourself that notification of new uploads that I put to YouTube. Honestly, man, leave your comments at the bottom. I love reviewing them. I do my very best to respond to you guys in the community. And thank you again for tuning in to this top tips, man, for investing in 2019. Good luck in your investment future.